Your savings aren't the only thing in distress right now. AI companies just spent more on infrastructure than most countries' entire GDP, and your electric bill keeps climbing too. We made a really expensive Magic 8 ball that needs more electricity than Michigan in winter. The market loved the story. Stock prices doubled in 5 years. But here's the catch. Most headlines aren't about how much value AI created. They're just about how much stock prices went up. Which is like saying your house is worth $1 million because one person offered that much while ignoring the roof leaks and foundations cracked. When company value jumps by hundreds of billions, that money didn't magically appear. It just means the last person who bought paid more than before. It's like scalpers selling concert tickets for 10 times face value. That doesn't mean the band got 10 times better, it means someone overpaid. Wouldn't you ask to see the receipts before committing your life savings to it? Instead, we got promises. So let's stop looking at stock charts and start counting what's real. The money, the chips, the electricity, the people, and whether any of it actually works. Because if you burn through trillions and get autocomplete that occasionally guesses your next word, that's not a revolution. That's just a really expensive thesaurus with a subscription fee. This bubble is metal, electricity, and mostly invoices. The grid? That's the first problem sitting in your power lines right now. Data centers are eating more electricity than small cities. The grid is already maxed out. Grid operators are literally saying there's nowhere left to plug these things in. You can't build new power plants in months. You can't install transmission lines overnight. But AI companies need power today. It's like ordering a house, but the electrical grid says, sorry, we're full. So what do? You overpay for priority access. 4 companies spent $344 billion on data center infrastructure in 2024. That's just the buildings, not the power upgrades, not the transmission lines, not the new power plants coming later. They're talking about spending trillions more in the next few years. Meanwhile, your electric bill is climbing. Energy companies are offering new rates to corporate customers. Data centers get first pick of available power. Households get what's left. Prices go up to fill the gap. It's the concert scalper situation all over again, except this time it's your electricity. The grid doesn't care about quarterly earnings. When power runs out, power runs out. AI companies are betting they can outspend this problem long enough for someone to build more infrastructure. They're betting trillions that power will show up eventually. Except infrastructure takes years. Permits take years, construction takes years, spending happens in quarters. That gap, that's where your bill lives. Then, where is the ROI? There's your second problem, spoiler alert. It is worse than the first one. You're not actually getting anything back. Companies are spending billions plugging AI into workflows. Most aren't seeing returns. They're seeing demos, impressive presentations, intern-level results. But actual measurable improvements to cost per task? Still coming. Take coding. Everyone said AI would replace developers. Instead, companies hired quality assurance people to fix AI code. So now you need a human to check the machine's work. That's not automation, that's adding a step. Same with customer support. AI handles the first message, then hands off to a human because the answer was confidently wrong, or incomplete, or hilarious. Marketing teams use it to draft copy, then rewrite it because it doesn't sound like their brand. Most AI in actual workflows does 60 to 70% of the job. The last 30% requires a human with context, judgment, and the ability to say, that's wrong. And that human costs money, insurance, vacation, raises. Companies aren't replacing headcount, they're adding tools that create more work. It's like hiring an assistant who gets 70% right and leaves the rest for you. That's not helpful. That's expensive. Earnings calls are full of big wigs saying, we're in experimentation phase. Translation? We spent hundreds of millions and aren't sure what we bought. Some companies are quietly scaling back, others are doubling down because admitting failure means explaining it to shareholders. They keep spending, they keep experimenting, they keep waiting for returns. You're paying the power bill while they wait. Do you see the trap yet? The third problem is why this keeps happening despite everything screaming stop. Incentives are backwards. Boards reward companies for having an AI strategy, not for proving it works. There's a huge difference. CEOs are terrified if they look late to the party, way more afraid of that than burning cash. If you announce we're investing in AI, stock goes up. If you announce latest AI experiment failed, stock tanks. Guess what everyone announces? Private investors make this worse. Startups raise billions on pitch decks and PowerPoint demos. Valuations skyrocket between rounds without anyone checking if companies make money. Story matters more than numbers. Narrative is worth more than product. Some startup announces a breakthrough. Investors dump money in. Valuation explodes. A year later, the breakthrough is overstated. But founders already sold at the peak. Early investors already cashed out. By the time reality catches up, everyone moved on. It's a treadmill where getting in early wins over getting it right. Everyone knows this. Nobody wants to be the person who stops spending. Imagine being a CFO saying, "We're scaling back AI spending because ROI isn't there." Your board replaces you within a quarter. So everyone keeps spending, keeps raising valuations, keeps telling the story. Incentives reward being early, not being right. Being early doesn't care about physics or returns or whether the grid can handle it. Being early just cares about momentum. Moving on, and there comes the pop. What happens when this bubble pops? The air comes out. The boring stuff wins. Not flashy consumer apps, not revolutionary chatbots, not companies with the best marketing team. Winners are infrastructure, chips, power, data plumbing, the unglamorous backbone. During the dot-com bubble, tons of companies died. Companies that built internet infrastructure, they survived. They made money. Same thing happens here. Right now, enterprises are in experimentation mode, running pilots, spending like mad. When that ends, they move to prove it on the P&L mode. That's when the CFO asks, does this reduce costs? Most pilots fail that test. Survivors are usually boring. Document processing, data categorization, back-office automation that saves real money. Nobody does a TED Talk about document processing, but someone's definitely making money on it. That's what survives. If you work in infrastructure, you become more valuable. If you use AI at your job, tools get better because they have to prove themselves. Your electric bill stops climbing as fast because demand finally matches infrastructure growth. But that's years away. Right now, money's still flowing. Spending, accelerating. The question isn't whether this bubble exists. The question is when it pops and what you do with that information right now. Here's the map and what this means for your wallet. First, stop buying the story. Companies are still spending because they're afraid of looking late. That's not a reason for you to invest based on hype. If you're tempted by AI stocks, separate the narrative leaders from cash flow beneficiaries. Semiconductors, power infrastructure, and data plumbing have first claim on the money. End-user apps have to prove retention, not just reach. Second, if you use AI tools at work, figure out what actually saves time, not what sounds impressive in demos, what genuinely reduces your workload. Third, optimize the bills you actually pay right now. Don't wait for AI to make you rich later. Your electric bill is climbing today. Fourth, if you work in tech, the market gets way tighter. Companies stop hiring based on hype. They start hiring based on what actually reduces cost per unit. Skills matter more than job titles now. Most importantly, don't let corporate spending patterns dictate your personal spending. Your budget isn't a venture capital fund. It doesn't reward being early. It rewards making it to the next month. The bubble's still inflating. Companies are still spending like the grid has unlimited capacity, but you don't have unlimited capacity. Your paycheck has limits. Your time has limits. Your electric bill has limits. Protect those first. When this all settles, here's what we're left with. Boring wins, always does. The flashy startups with million-dollar pitches, most disappear. The founders who got rich early already cashed out. The VCs who funded them already moved to the next story. What remains is the infrastructure that actually works and pays for itself. Data centers that have stable customers and positive unit economics. Not experimental ones built hoping someone will pay premium prices. Semiconductors that manufacturers actually need, not speculative investments betting on demand that never materializes. Power grids that got upgraded, not promises of power that never showed up. Software that quietly reduces cost per task, not revolutionary AI that requires a human to check its work anyway. The boring stuff doesn't make headlines. It doesn't get VC funding rounds. It doesn't inspire conference keynotes. But it makes money, consistently, year after year. That's why it survives. For companies, survival means abandoning experiments and committing to what works. For workers, it means building skills in infrastructure, not chasing the latest AI trend. For you, it means building a financial foundation that doesn't depend on any of this working out. Emergency fund, boring investments, bills covered first. Because whether AI changes everything or nothing at all, you still need to pay your electric bill next month. And that bill's not going down. It's happening now. If this breakdown helped you separate the hype from the math, subscribe for more economics and finance dissection with the stuff they don't teach in school, but you need to know because the next money trap is always out there. And it's always dressed up for success. Catch you all up in the next one.